So the first step is to identify and analyze business transactions, such as sale, purchase, expenses, and payments. This involve understanding the nature of each transaction in its impact on a financial statement. So once the transactions are analyzed, they are recorded in a general journal. Each entry includes the dates, accounts affected, and the amount of the transaction. Debits and credits are recorded following the principle of double entry bookkeeping. So the information from the general journal is transferred to the general ledger. So the general ledger contains individual accounts of each asset, liabilities, equity, revenue, and expenses. Posting involved updating the account's balance with the debits and credit from the journal entries. So after making adjusting entries, an adjusted trial balance is prepared. This includes the updates accounts balance after the adjusting entries have been made. So prepared financial statement. Using the adjusted trial balance, financial statement are prepared. The key financial statement includes the income statement, statement of earnings, balance sheet, and statement of cash flows. These statements provide an overview of organizational financial performance and position. So next is to prepare an adjusted trial balance to ensure that the total debit equal to the total credit in the general ledger. These steps help in identifying any errors or imbalances in the recording processing. So adjusting entries are made at the end of an accounting period to ensure that revenue and expenses are organized in appropriate period. This entry adjusts for items such as accrued expenses or prepaid expenses and depreciation. So also it is recorded in a general journal and then posted to the general ledger. So closing entries are made to transfer the balances of temporary accounts to the retained earning accounts. This process set the temporary account to the zero in preparation for the next accounting period. So after the closing entries are made, a post-close trial balance is prepared also. This trial balance ensures that all the temporary accounts have been closed and that the ending balances of permanent accounts are carried forward to the next accounting period. So after that, lastly, we can use revising entries. It is optional, but in some cases, accountants may have been used revising entries at the beginning of a new accounting period. So revising entries simplify the recording of certain transactions such as accrual and deferral by eliminating the end of adjusting entries. And those are the 10 accounting cycle in accounting. So by the accounting cycle, businesses can maintain accurate and reliable financial record which are essential for making informed businesses decision and fulfilling reporting requirements. And that's all for today. Thank you and God bless.